Debt to GDP in the United States is about 124%. And we've got a fiscal train wreck going on, and the government, what happened is the government spent a lot of money during the COVID event, and they never cut back. In fact, they stepped on the gas. And so we just finished a year where they spent $6.75 trillion, which is almost as much as they spent in the peak year of COVID. And we've got an economy that's full employment, or close to full employment. And we've got a stock market that's at record highs, and of course they did a lot of it. They did this to try to win the election, and they weren't successful. But I think that's part of the reason why they were so profligate. And really until Trump won, and now they've created this Doge committee, there's been zero discussion about the debt problem. But it's a big problem, and it's going to cause serious economic issues. It's hard to say. I mean, so as you know, this Doge committee, Ramaswamy and Elon have decided they're going to try and cut $2 trillion in annual costs. And, my response to that is good luck. I mean, I'm all in favor of what they're trying to do. And I do believe they will cut some costs. No doubt there is some government fat. But as I said in the speech I gave here a few days ago, 80% of the money that's spent by the federal government is in the big four categories, which are Social Security, Medicare, defense, and interest. And so those are very hard to touch. Go after entitlements, that's like the third rail. Defense, maybe they'll take some money out of that if they get peace in the Ukraine. But the interest costs continue to ramp every year, and defense is pretty untouchable as well, although maybe they'll be able to cut something there. The remaining 20% is the rest of the government, and even if they take a hatchet to that and cut 30% of that, it's a couple $100 billion a year in savings. In a year where, last year they ran 1.8 trillion in deficits, and this last 6 months annualized, the deficit run rate right now is $2.4 trillion. So, let's just say, give them their due. Maybe they cut $400 or $500 billion, and that would be hard to do, but maybe possible. It would still only take you from 2.4 back to where we are now, 1.8, 1.9. And the point is, the slope of all the curves is accelerating very steeply. Interest cost, federal spending, deficit, et cetera. And this is going to lead, in my view, as I've said many times, is going to lead to a sovereign debt crisis and a currency crisis. And you can already see that. The evidence that that's taking place is that Bitcoin's at record highs and gold's near record highs. And gold was at a record high just recently, just backed off a little bit. But, gold started the year under 2070. And now we're playing around with 2,600, 2,700. Bitcoin started the year, at 58, it was even lower than that, I believe, but it was at 58 for a big part of the year. And of course, now we're pushing up against 100. So these two sound money assets, sound money alternatives, things that could be a neutral reserve currency, they know it. They can see the problem. And they're responding.
So what do you think? Do you think the average population, we've been watching these inflows, do they understand?
No, see, that's the thing. I don't think most people get it. I think a lot of people look at this and they, particularly, I noticed in the gold space, the gold stocks, as you know, and as I've talked about other podcasts, really haven't responded the way they should have. Gold's up 30%, the stocks are up 30%. Typically, the stocks are 2 to 3x the gain of the underlying metal. And in this case, that has not happened. And the reason for that is if you go on Bloomberg and you check the future forecast, nobody thinks the gold move is real. Everybody thinks, oh yeah, it's at 26, but it's coming back to 2,000. And the ASICs, which is the all-in sustaining cost of mining an ounce, are going to continue to march up with inflation. $2,000, pretty soon your margins are gone, right? And so what's got to happen is there's got to be a shift in psychology where people say, oh, this is the real deal. And gold's not stopping at 25 or 26. Gold's going to 3, and then it's going to 4, and then it's going to 5. And I think those things are happening, obviously, over a course of several years. But until they get this fiscal thing solved, and it's not an easy fix, to me, it's very, very clear that we've got inflation in our future. It's a mess. It's a real mess. And this is a fiscal mess without the stock market or the economy being in trouble. The last two times the stock market went down substantially in the 08 bust and in the 2000 bust, you had enormous deficits following it. You had an enormous unemployment following it. And so if our stock market gets broken at some point, then I think I'll move into kind of the next point, which is I think we know how the Federal Reserve is going to have to respond. And I call it the big print. Mm-hmm. They're just going to have to, go back to QE, go back to ZIRP, maybe do yield curve control. And we're already starting to see that. I find it extremely interesting that the bond market here they are, they've cut interest rates, and yet the longer bond, has gone up since that interest rate cut. And I'm kind of like, wow, how did that happen? Doesn't make sense.
In your presentation, you said that it's only a matter of time. This big print is coming, as you just mentioned. The Fed's balance sheet will go over $20 trillion. Elaborate on this. How soon? What does that look like?
Some people say that's hyperbolic, but it's not if you really look at the trend. I mean, if you look at what they created in the dot-com burst, if you look at what they created in the GFC, if you look at what they created with COVID, each one gets progressively larger, right? It took Bernanke 4 or 5 years to print a couple, trillion, 2-3 trillion. It took Powell six to 18 months to print 5 or 6 trillion. So it was really kind of nuts. And I think that in order to save the next one, they're going to have to spend, it's going to be kind of unlimited. I mean, he will have to do what I call a Mario Draghi, which is he'll have to say, whatever it takes. Yeah. and my sense is it's going to take a great deal if the stock market comes off hard. And so to me, that the two things that I'm watching that I think are the big triggers, I'm watching the bond market and I'm watching the stock market.
Timeline though, this year, like what you worry?
I don't know. Nobody knows, right? But it feels like we're getting close. I mean, we know that the bond market, when the 10-year gets over 5, we know they have a problem. That happened in September of 2023, and they immediately came out. 12 Fed governors came out and started jawboning it down. So it kind of 5% on the 10-year seems to be like a trigger point. Mm-hmm. The stock market, I don't know. It just keeps on rolling, and it could roll higher. There's a guy I respect, David Hunter, who's on Twitter and is ex-Fidelity manager, very seasoned, and he thinks we melt up to 7,500 on the S&P. And for all I know, we could. I mean, there's a lot of excitement around this new administration. But if you look at Hussman's numbers or any of the valuation metrics like the Buffett indicator and PEs and price to book, well, book doesn't matter anymore, but you look at all the valuation, we're redlined, like we're right at the top. I mean, markets don't get more expensive than the stock market is right now. They just don't. And so when does that end? I don't know. I mean, maybe it could get more expensive still. I'm not shorting it, but I surely tell my clients, I don't think that's an area where you want to be heavily long.